Ladies and gentlemen, imagine waking up one morning to headlines screaming that an entire nation has pulled the plug on an industry worth hundreds of billions of dollars. Imagine the lights going out in warehouses the size of football fields, thousands of machines falling silent at once, and a digital heartbeat suddenly skipping. This is exactly what happened when China shut down more than 400,000 Bitcoin miners. For years, China had been the unseen engine behind the world's largest cryptocurrency, quietly powering a massive share of the global network. And then, almost overnight, it stopped. At first, the world reacted with shock. Bitcoin's price trembled. Fear flooded the market. Analysts rushed to explain what this meant, and critics declared that this was the end, that Bitcoin could not survive without China. But history has a strange way of exposing shallow thinking, because what came next wasn't just unexpected, it was far worse and far more revealing. When those miners were shut down, it wasn't simply a regulatory move. It was a statement of control. It was a reminder that when systems are centralized, when power is concentrated, a single decision can wipe out years of investment and effort in seconds. Hundreds of thousands of machines, billions of dollars in infrastructure, and countless livelihoods were rendered useless with one order. That alone should make anyone pause. But the shutdown was only the beginning. What followed was a tightening grip, not just on mining, but on capital, information, and financial freedom. Exchanges were restricted. Transactions were monitored more aggressively. Citizens were warned, pressured, and in some cases punished for participating in decentralized systems. The message was clear. Money should be visible, controllable, and programmable by the state. And if that meant crushing innovation, so be it. Yet here's the part most people missed. While the crackdown looked like a disaster, it triggered something far more powerful. The miners didn't disappear. They moved. They packed up their machines, crossed borders, and scattered across the world. Hash power flowed into new regions. The Bitcoin network didn't die. It became stronger, more distributed, and more resilient than ever before. What was supposed to break the system ended up reinforcing the very idea Bitcoin was built on, decentralization. But then came the worst part. After forcing miners out and driving crypto activity underground, China accelerated the development and promotion of its own centralized digital currency, a system where every transaction could be tracked, where spending could be restricted, where access could be granted or revoked with a keystroke. This wasn't just about banning Bitcoin anymore. This was about replacing an open, borderless financial system with a closed one, designed for surveillance and control. Think about what that means. In one model, you hold your own keys, you control your wealth, and no authority can freeze your assets without your consent. In the other, your money exists only as long as you are compliant. Spend too much, speak too loudly, step out of line, and access can vanish. That is not innovation, that is power disguised as progress. And this is why this story matters far beyond Bitcoin. It's not about charts, prices, or profits. It's about choice. It's about whether the future of money belongs to individuals or institutions, whether technology will be used to empower people or to monitor them. China shutting down 400,000 Bitcoin miners was dramatic, yes, but what it did afterward revealed the real intention. Still, there is a lesson here, and it's a hopeful one. Bitcoin survived. It adapted. It proved that no single country, no matter how powerful, can destroy a truly decentralized network. The attempt to control it only highlighted why it exists in the first place. Every block mined outside of centralized control is a quiet act of resistance. Every transaction validated by a global network is a reminder that alternatives are possible. So when you hear about bans, crackdowns, and fear-driven headlines, remember this moment. Remember that systems built on freedom bend, but they do not break. And remember that sometimes when someone tries to shut something down, they unintentionally reveal just how dangerous that thing is to those who crave control. Ladies and gentlemen, the story of those 400,000 miners is not a story of defeat. It is a warning, a lesson, and for those paying attention, a signal. The future of money is being decided right now, not by speeches or slogans, but by choices. And the question is simple: will we choose control, or will we choose freedom? When China shut down more than 400,000 Bitcoin miners, the impact was immediate and brutal. In a matter of days, entire mining farms went dark, some of them housing tens of thousands of machines that had taken years to build and optimize. These were not small operations run out of garages. They were massive industrial facilities backed by serious capital, long-term planning, and complex supply chains. Yet none of that mattered. With a single policy decision, billions of dollars in equipment, infrastructure, and future revenue were effectively erased. This moment exposed a hard truth that many people prefer to ignore. When power is centralized, no amount of investment can protect you from sudden destruction. For years, China had been the heart of Bitcoin mining, controlling a majority of the network's hash power. This concentration seemed efficient, even profitable, until it became dangerously fragile. The shutdown revealed how quickly an entire global system could be shaken when too much control sits in one place. Workers lost jobs overnight, companies collapsed, and investors watched helplessly as their operations were rendered illegal without warning or negotiation. There was no gradual transition, no safety net, and no appeal process, only compliance or ruin. What made this even more alarming was the precedent it set. If one government could eliminate an entire sector so rapidly, it sent a clear message to innovators everywhere: your success exists only at the permission of authority. This wasn't just an attack on mining, it was an attack on predictability, trust, and economic stability. Businesses thrive on certainty, and that certainty vanished in an instant. The shutdown became a living example of why centralized control, no matter how powerful or organized it appears, carries an inherent risk. It can grow fast, but it can also destroy faster. The shutdown was officially framed as a response to energy concerns and financial risk, but beneath the surface it was something far more strategic. This move was about control. Bitcoin represents a system that operates outside traditional authority, where value can move without permission, and wealth cannot be easily frozen, censored, or redirected. For a state that prioritizes strict oversight of capital flows and monetary behavior, this kind of independence is a direct challenge. By targeting miners, China was not just regulating an industry, it was cutting off the foundation of a parallel financial system that it could not fully command. Mining gives power to those who secure the network, and by allowing such power to exist independently, the state risks losing influence over how money is created and transferred. Shutting miners down reasserted a clear hierarchy. Financial activity must remain visible, traceable, and subject to approval. The action also served as a warning to businesses and citizens alike that participation in decentralized systems comes with consequences. It reinforced the idea that innovation is welcome only when it aligns with centralized oversight. In that sense, the ban was less about Bitcoin itself and more about preserving authority over money, behavior, and economic direction. When the news of the shutdown broke, the global market reacted exactly as fear-driven systems usually do. Prices dropped sharply, headlines turned dramatic, and social media filled with predictions of Bitcoin's collapse. Many believed that removing such a massive portion of the network's mining power would cripple the system beyond repair. After all, China had controlled a significant share of the global hash rate for years. The assumption was simple and alarming. If China was Bitcoin, then Bitcoin without China would fail. But what followed challenged that belief at its core. Yes, the network slowed temporarily. Block times increased, transactions took longer, and uncertainty dominated the conversation. Yet Bitcoin did not stop. Blocks kept being mined, transactions kept being confirmed. The protocol adjusted exactly as it was designed to do. Difficulty levels recalibrated, allowing the remaining miners to continue securing the network. This moment was not chaos. It was a live stress test, and Bitcoin passed it in front of the entire world. The price volatility, while intense, revealed more about market psychology than about Bitcoin's actual health. Fear magnified uncertainty, and uncertainty triggered panic selling. But beneath the noise, the fundamentals remained intact. There was no central server to shut down, no headquarters to raid, and no CEO to silence. The system functioned precisely because it was built to survive hostile conditions. What many saw as weakness was, in reality, proof of resilience. As days turned into weeks, confidence slowly returned. Hash rate began to recover as miners relocated and new operations came online elsewhere. The network didn't just survive the shock, it began to stabilize in a way that reassured long-term participants. Observers who had predicted the end of Bitcoin were forced to revise their narratives. The event made one thing undeniable: Bitcoin does not depend on any single country, policy, or authority. This realization marked a turning point. The market learned that temporary disruption does not equal failure. Bitcoin's survival through one of the most aggressive crackdowns in its history exposed a fundamental truth: decentralized systems are designed to bend under pressure, not break. What looked like a fatal blow became one of the strongest demonstrations of why Bitcoin continues to exist despite constant opposition. When mining operations were forced to shut down, the machines did not vanish and the people behind them did not give up. Instead, one of the largest migrations in modern digital history began. Rigs were dismantled, packed into containers, and shipped across borders to countries that offered clearer regulations, cheaper energy, and greater long-term stability. This movement transformed what had once been a heavily concentrated industry into a far more globally distributed network. What was previously centered in one region began spreading across North America, Central Asia, Europe, and parts of the Middle East. This migration was not easy or cheap. Miners faced logistical nightmares, regulatory uncertainty, and months of downtime. Yet the incentive structure of Bitcoin pushed them forward. Where there is cheap power and legal clarity, mining will exist. As new facilities came online, hash power began to rebalance, and with it came a shift in control. No single country now held the dominance China once had. The network became harder to influence, harder to censor, and harder to intimidate through policy alone. This redistribution strengthened Bitcoin at its core. With mining spread across multiple jurisdictions, political risk was reduced. A crackdown in one country could no longer threaten the entire system. Each new region added another layer of resilience, another checkpoint against centralized pressure. Ironically, the attempt to control Bitcoin by concentrating power ended by dissolving that very concentration. The forced migration proved that decentralized is not just an idea written into code. It is an adaptive behavior built into the system itself. After pushing Bitcoin mining and trading out of the country, China did not step away from digital money. It moved in the opposite direction. The focus shifted toward accelerating a state-controlled digital currency designed to operate entirely under centralized authority. Unlike decentralized cryptocurrencies, this system was built with full visibility in mind. Every transaction could be traced, recorded, and analyzed in real time. What was presented as modernization and efficiency carried a deeper implication. Money would no longer just be a tool for exchange, but a mechanism for oversight. This approach reshaped the relationship between individuals and their finances. In a centralized digital currency system, access is conditional. Funds can be frozen instantly, spending can be restricted by location or category, and participation depends on compliance with rules that can change overnight. Unlike cash or decentralized assets, there is no privacy by default and no true ownership, only permission. By promoting this model after banning Bitcoin, the contrast became unmistakable. One system empowers users to control their wealth, the other ensures the state retains ultimate authority. The timing of this shift was not accidental. Removing decentralized alternatives first reduced competition and resistance, clearing the path for a controlled digital replacement. It sent a clear signal about the future direction of money: efficiency over freedom, traceability over privacy, and control over autonomy. This move went beyond economic policy. It revealed a broader vision where financial behavior becomes programmable, enforceable, and deeply intertwined with governance. In that context, banning Bitcoin was not the end goal. It was simply a necessary step towards something far more controlling. This entire episode exposed a deeper conflict that goes far beyond mining farms and market prices. At its core, it highlighted a fundamental struggle between two opposing visions of money. On one side is a decentralized system where individuals hold their own keys, control their assets, and participate without asking permission. On the other side is a model where money exists within boundaries set by authorities, monitored at every step, and governed by centralized rules. The crackdown made this contrast impossible to ignore. Bitcoin was created as a response to financial systems that rely on trust in institutions rather than in transparent rules. When China acted decisively against it, the reaction revealed exactly why such systems exist. The fear was not that Bitcoin was inefficient or dangerous, but that it removed control. Decentralized money challenges the idea that power over value must belong to a central entity. It offers an alternative where trust is distributed and enforced by code rather than commands. This moment forced people around the world to question assumptions they had long accepted. If money can be shut down, frozen, or redirected by policy, is it truly owned? If participation depends on approval, is it truly free? The events showed that financial freedom is not guaranteed by convenience or growth, but by structure. Systems designed around decentralization resist capture, while centralized systems invite it. By surviving and adapting, Bitcoin demonstrated that it is more than a speculative asset. It is a living experiment in financial autonomy. The conflict revealed by this crackdown is not temporary. It will continue to define the future of money, as societies choose between efficiency with control or freedom with responsibility.